Greetings. So, what are we looking to accomplish today? There are three things that I'd like to cover at Schwab Impact: tax policy, trade tariffs, and the interest rate environment. I'm going to be focused on asking questions related to those three topics, and hopefully I get some good answers.
We also have this relationship between the hard and the soft data. This has been a unique period of time because the so-called soft data, the confidence survey-based data, has been exceptionally strong, really for the last couple of years. A lot of people talk about the Trump effect. I also think it's because of the earnings recession that we came out of. You've really seen a lot of the economic strength driven by animal spirits or a lot of the soft data.
So I'm here with Liz Ann Sonders, who's the Chief Investment Strategist for Charles Schwab.
Hi, everybody.
And I just wanted to ask her a few questions about the things that I've been talking about. And the first question is, how do you feel that the CBO recently came out and said that over the course of 10 years, the tax cuts are going to add roughly $2.3 trillion to the overall national debt. And as of 2017, we already have a national debt to GDP ratio of around 105.4%. With the rising cost of social welfare, there are payments that need to be made on the interest and maturing principal. How do you view that, and what do you think the short to medium term outlook is? So
I think the short-term outlook on the deficit is an important one for reasons maybe that not enough people are talking about. So we put in this fiscal stimulus very late in the cycle, which is not normally the case. Normally you get a big tax cut, big fiscal stimulus at the beginning coming out of a recession. So this is unique. So it's expanding the deficit much later in the cycle. What that means is the Treasury is going to have to issue more Treasury securities to finance the deficit. At the same time, the Fed is no longer buying securities because they're shrinking their balance sheet. So I think that's causing some upward pressure on interest rates that people aren't talking about enough. But to your point, when you continue to run deficits, you are adding to debt. Debt is a cumulative effect of running deficits. You mentioned a little more than 100%. That's just federal government debt. If you look at total credit market debt, which is all measures of government debt, not just federal but state, local, all private sector debt, all public sector debt, financial debt, non-financial debt, we're at about 350% of GDP.
350%.
Now that's
of GDP.
down from about 380, all because of household deleveraging.
Okay.
And that does not include the future debt associated with unfunded entitlements. If you add a consensus estimate for what that represents down the road, you're up more like 900% of GDP.
So, and what have been some of the historical averages?
We've never been anywhere near this
close.
point. Now, this is not just a U.S. problem. Many other countries. Right. When I get asked the question, when are we going to finally hit the wall? I say, I think we hit the wall in 2008. And it took the entire global financial system down with it. And what it really unleashed was what had become a series of rolling debt crises.
So it just showed how
Eurozone debt crisis,
how sensitive and how easily irritable the entire system is with a certain point in time in the market.
I think the major implication of debt as high as it is here and many other places is it's a depressant on economic growth. It limits the ability for an economy to grow at an above trend pace for a sustainable period. So that's, I think, the biggest implication.
So when I look at the market volatility, to me, it's a response to a number of different uncertainties that are affecting the global outlook.
I'm here at Schwab Impact, and I'm here with Chris Karam. He's the CEO of Capital Advisors. I'm going to ask him a couple questions covering the three topics that we've been discussing, which are tax law, tariffs, and interest rates. With the Fed raising interest rates for a third time this year, and Trump making the remark that the Fed has gone crazy.
Sure.
Right? This sort of animosity between the Trump administration and now the Fed and Jerome Powell, does this create any kind of turbulence for the way market perceives the next interest rate hike, regardless of which direction it goes in?
Potentially. It could potentially get there. So one of the things that you have to be careful about when there's a tweet or something like that from the Trump administration regarding the Fed, which is supposed to be independent, is this concept where are the next moves, the corresponding moves the Fed makes, are they then considered political or influenced by somebody or something outside of their group? The reality is that the yield curve is tightening, is flattening. So when you see that, I'm sure the Trump administration would love to see a little bit more or a little bit less emphasis on near-term interest rate hikes, so that they can fuel some of this, some of the growth.
So when you
further.
mention the yield curve flattening, can you just explain briefly and simply what that is exactly?
Sure. So the Federal Reserve has control over the short end of short-term interest rates, and if they have been pushing short-term interest rates higher, but the rest of the marketplace has the influence over the direction of longer-term interest rates.
And what is the breakdown of short-term and long-term? Like what is it?
Let's call it 0 to 3 months.
0 to 3 months is short-term, and
And-
long-term is considered 3 months plus.
Sure. And longer-term rates are typically set by market forces. So the market forces haven't forced medium and long-term rates higher
Right.
at the same rate that the Federal Reserve has been pushing short-term rates higher over the last couple of years. And that's been influencing how portfolios are managed, because now people can get a little something for not much risk in terms of yield, whereas a couple of years ago they couldn't get really much of anything in terms of yield, maybe zero.
At what point do the yields on whether it's short-term or slightly longer-term bonds get to a point where it's attractive enough for investors to have a sell-off in the equities market? And I think the S&P 500 has roughly a 2% dividend yield.
And I think you touched on it real well, that the dividend yield on the S&P 500 is now below the yield that you can obtain on a 10-year treasury.
Right.
And so that is the competition. That is the competition for the marginal dollar that investors make in their portfolios. They put it in stocks, they put it in bonds, and ultimately this is what's driving perhaps the most recent market correction, where
Is that fear that the yields are becoming more attractive, and there's going to be a rebalancing and
That's right.
reallocation inside, an array of portfolios across the United States for all the advisors that are looking at the same data and saying,
Right.
hey, maybe it's time to realign.
Yeah, and the reality is, why not invest a portion of your portfolio in something that's very, very, very low risk, where you can capture 2+% yield?
Right.
And that means your equities just don't either don't have to have as much equities in your portfolio to meet your target return, and your equities just simply have to do less work in your portfolio to capture your desired yield, your desired total return. So that's having a big impact, and perhaps adding to the market volatility that we've seen here recently, because there is now a healthy competition between stocks and bonds.
The corporate debt that's highly rated, AAA highly rated corporate debt, and treasuries. What we've seen in the 2008 financial crisis is that some of it wasn't that great. Right? Some of it wasn't that credible. Wasn't really AAA. Has that completely changed? And can investors really rely on the guarantee of face value maturing bonds and fully have that confidence to reallocate their portfolios towards fixed income and have a sell-off in equities, and be confident that even though the face value will drop because of market conditions, when it comes time to maturity, they'll get their principal back and the coupon rate that they've been getting in return?
Sure, we have seen, however, credit quality within the broader index. So if you look at the Bloomberg Barclays Aggregate Bond Index, we have seen credit quality lowered somewhat. So the average credit quality has declined. You see a lot more BBB, for example, rated credit, and compound that with additional duration that you're seeing here recently with the bond index. And so that's probably a bigger area of concern, is the, of course, mitigating what you're describing is best through offering a much broader diversified suite of securities or instruments. But at the end of the day, what investors should be really looking at is the credit quality of the content of that portfolio, also the duration of that portfolio, and that's really ultimately what's going to drive results.